Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
It is great to be back. And honestly, looking at the spread of sources we have in front of us today, I mean, we've got CNBC, Bloomberg, Reuters, MT Newswires. It feels like we are looking at two completely different realities, just layered right on top of each other.
Yeah, I couldn't agree more. It is Friday, February 20th, 2026, and I have to say, the mood out there today is heavy.
It really is.
It's disjointed. You know those days where the news ticker just makes you feel like the ground is shifting under your feet, but you can't quite tell which direction it's going to slide?
That is exactly the perfect way to describe it. We are seeing this massive divergence in the narrative today. On one side, you have these flashing red warning lights in the credit markets, like actual structural cracks appearing in places we were all told were safe.
Right.
And then on top of that, actual war drums beating in the Middle East.
And then on the exact other side of things, we have what might be the single most optimistic, most expensive bet on the future of technology we have literally ever seen.
Yeah, it's wild.
It's fear and greed, but they aren't taking turns anymore. They are wrestling for the steering wheel at the exact same time.
Which is exactly the mission for this deep dive today. We need to connect some dots for you that just do not seem like they belong on the same page.
Right.
We have to explain how a firm named Blue Owl, a $30 billion check from NVIDIA, and a 10-day deadline from the White House regarding Iran are all somehow part of the exact same financial ecosystem.
So let's start with the fear. Let's just rip that Band-Aid off immediately.
Yeah.
We need to talk about Blue Owl.
Yes.
Now, if you aren't deep in the weeds of alternative asset management, Blue Owl might sound like, I don't know, a trendy coffee shop down the street.
Yeah, right, or a children's book publisher.
Exactly. But they are causing some serious heartburn on Wall Street this morning.
They certainly are. And to really understand why this matters to you, we have to step back and define what Blue Owl actually does. They are a titan in what is called private credit.
Okay, let's pause right there and unpack that term, because we hear private credit thrown around constantly in the financial press.
All the time, yeah.
So for the listener who maybe hasn't been tracking the whole evolution of shadow banking, how is this different from just a regular bank?
That is a great question. So think back to the 2008 financial crisis. After everything crashed, regulators came in, and they basically made it much harder for traditional banks to lend to somewhat riskier, smaller companies.
They tighten the screws.
Exactly. They really tightened the screws. So private credit firms stepped right into that void. They are non-bank lenders. They take money from huge investors, so think pension funds, endowments, wealthy individuals.
Institutional money.
Right. And they lend that money directly to companies. It's a massive trillion-dollar industry now.
And it's been the golden child of Wall Street for the last decade, mostly because the yields were just higher than what you could get in the stock market or in standard bonds.
Yes, investors absolutely loved it because it offered steady, high returns. But, and here's the huge catches, private credit assets are incredibly illiquid.
Meaning you're stuck in them.
Pretty much. You can't just sell a private loan on an exchange the way you would sell a share of Apple stock. It takes time. It's sticky. And the headline we are looking at from CNBC today is that Blue Owl has sold $1.4 billion of loan assets from 3 of its private debt funds.
But I mean, selling assets doesn't inherently sound like a crisis, though. Companies sell things to rebalance their portfolios all the time. So why is this specific sale triggering alarm bells across the whole sector?
It is the context of the sale. They are selling these loans specifically to shore up cash because they are facing this massive wave of redemption requests.
Investors want out.
Investors want their money back.
Yeah.
And crucially, CNBC reports that Blue Owl is curbing liquidity payments.
Okay, so curbing liquidity payments. That is just corporate speak for, hey, you can't have your money right now, isn't it?
That is exactly what it means. It's often called fence gating in the industry.
Yeah.
They are limiting how much investors can withdraw in any given period.
Wow.
Yeah. When you combine selling assets quickly, which often means you're selling them at a discount, with telling investors no when they ask for cash, it signals distress. It signals that the math just isn't working the way it used to when money was cheap.
This feels a lot like the classic run-on-the-bank scenario from a history book.
Yeah.
Just without the physical bank lobby and the angry mob outside.
It is a fundamental liquidity mismatch, and this feeds perfectly into the private credit bubble theory that market bears have been warning about for years.
Because interest rates were near zero for so long.
Right. It was an era of easy money. Lenders got really complacent. They chased higher yields by making riskier and riskier loans. Now rates are higher, the economic tide is turning, and those risky bets are really starting to bite.
So Blue Owl is essentially the canary in the coal mine here.
That is the big fear today. If a player as sophisticated and as large as Blue Owl is having to fence-gate their investors, it strongly suggests the stress isn't just isolated to one badly managed fund.
It's systemic.
Exactly. It suggests the stress is systemic across the industry.
And the market really sniffed this out immediately. I was looking at the sector performance from Thursday, and it was not pretty.
It was an incredibly ugly day for financials. Investors didn't even wait for a detailed explanation. They just hit the eject button. We saw Blackstone, ticker BX, drop over 5%.
Ouch.
And Apollo Global Management, ticker APO, also down over 5%.
I mean, that is a significant haircut for the absolute giants of the industry.
Right, it is. The market is pricing in contagion. It's a very stark reminder that the easy money hangover is real, and we might just be waking up to the headache right now.
Okay, so we have a potential liquidity crisis brewing in the credit markets.
Yeah.
That is honestly enough to ruin a weekend all on its own.
Without a doubt.
But that wasn't the only thing dragging the mood down today. We have to pivot over to the geopolitical situation, which arguably feels even more precarious this morning.
Yeah, this is the heavy part of the news cycle we touched on in the intro. It shifts from just financial numbers on a screen to actual real-world consequences.
Right, because CNBC is reporting on some very sharp escalations between the U.S. and Iran, and this has moved way beyond just vague political rhetoric or posturing. We actually have a timeline now.
That's the critical change in the narrative. President Trump stated on Thursday that he will decide within 10 days whether to authorize a military strike on Iran.
10 days. I mean, that is a literal countdown clock.
It is a countdown clock. And it's not just talk. The reporting indicates a significant buildup of American forces near Iran right now. And look, the market hates uncertainty.
Yeah.
But it hates war even more. Traders are looking at that 10-day window, and they are rapidly pricing in a worst-case scenario.
And when the market gets scared of war, the capital flows change direction almost instantly. It stops being about growth and tech multiples and starts being entirely about survival, or at least defense.
Precisely. We are seeing a textbook flight to what traders call the guns and oil trade.
Yeah.
If you look at the defense sector today, it is absolutely flying.
Yeah, I saw GE Aerospace is just tearing it up.
Hitting all-time highs. GE Aerospace is up 9% just in the month of February. Lockheed Martin is also hitting brand new highs.
Because the logic is straightforward.
Yeah. The grim logic of the market is very simple here. If tensions escalate, these companies get the defense contracts. They are the ultimate hedge against geopolitical chaos.
And then, of course, there's the other side of that coin, which is energy. Because if the Middle East even sneezes, oil prices catch a cold.
Right. Or rather, they catch a fever.
Exactly.
Uncertainty in the Middle East always hits crude prices first. WTI crude is up about 16% this year so far. Brent crude is up around 18%.
That is a massive move for just being under 2 months into the year. And for the listener at home, why does this matter if they aren't day trading oil futures? Why should they care about WTI crude?
Because oil is essentially a tax on absolutely everything.
Right.
When oil goes up, transport costs go up, manufacturing costs go up, and eventually the price of your groceries goes up.
Which hits the consumer directly.
Exactly. So you have private credit tightening financial conditions, making it harder for businesses to get loans. And at the exact same time, oil prices are tightening consumer wallets. It is a really tough double whammy for the broader economy.
Okay, so if we stop this deep dive right here, I think I'd just go hide under my desk.
Yeah.
We have credit markets cracking and a literal war looming.
It's bleak.
But, and this is the wild cognitive dissonance part of today's news, there's this completely other narrative happening simultaneously.
The great tug of war. We have to talk about the tech sector.
Yes. Because while the rest of the world is deeply worrying about debt and missiles, NVIDIA is apparently looking at its bank account and saying, let's just go ahead and make history.
That's certainly one way to put it. CNBC is reporting that NVIDIA is in talks right now to invest up to $30 billion into OpenAI.
$30 billion. I just really want to make sure you, the listener, hear that number. That isn't a seed round. That is roughly the GDP of a small country.
It is genuinely staggering. And the valuation implications of this are even crazier. If this deal goes through, it would value OpenAI at roughly $730 billion pre-money.
$730 billion. for a company that is still private.
Just to give you some context on that scale, that makes OpenAI more valuable than Tesla. It makes it more valuable than JP Morgan Chase.
Wow.
It would make it one of the most valuable entities on the planet, and as you said, it isn't even publicly traded yet.
That is just mind-boggling. But I have to ask the skeptic's question here. Why is NVIDIA writing a check that big? I mean, they make the chips OpenAI uses. Isn't OpenAI already paying them billions of dollars? Why send the money back?
Because it is the ultimate ecosystem play. It is perfect symbiosis. NVIDIA makes the H100s and the new next-gen Blackwell chips.
Right, hardware.
Yes. And OpenAI desperately needs those exact chips to build agentic AI. AI that can act on its own, do tasks for you, not just chat with you. By injecting this massive amount of capital, NVIDIA essentially ensures that OpenAI has the cash to keep buying NVIDIA chips for years to come.
So it's essentially vendor financing on steroids. Like, hey, here is $30 billion. Please exclusively use it to buy my product.
Exactly. It locks in their single biggest customer and ensures that the whole AI boom, which is what drives NVIDIA's stock price in the first place, doesn't run out of fuel. It's funding the revolution to ensure you stay the absolute king of the revolution.
But is it just about money at this point? Because I noticed a really interesting detail in the CNBC reporting. They had an interview with Demis Hassabis, the CEO of Google DeepMind.
Yes.
And he kind of threw a bit of cold water on the speed of all this.
He really did. And this is a very crucial nuance for anyone who is betting heavy on AI right now. He pointed out a bottleneck that cash cannot instantly fix. He said the limiting factor for agentic AI right now isn't actually money, it's memory chips.
Just physical hardware limitations.
Right. You can have all the GPUs in the world, but if you don't have the high bandwidth memory to feed them data fast enough, they just sit idle. The physical supply chain is still the brake on the car, no matter how much gas NVIDIA pours into the tank.
Which naturally brings us to the global competition. Because the U.S. isn't the only car racing on this track.
No, not at all. And this actually connects right back to our geopolitical tensions from earlier. It's all one big web.
Right.
Remember a few years ago when Sam Altman, the CEO of OpenAI, was visiting India? He made a comment that it was totally hopeless for Indian engineers to compete with U.S. foundation models.
I do remember that. It sounded pretty arrogant at the time, honestly.
Well, the global landscape has shifted dramatically since then. China's DeepSeek has recently emerged as a very serious contender, and they are directly challenging that narrative that the U.S. is untouchable. The gap is closing way faster than many people in Silicon Valley expected.
And that actually brings us to a much darker side of this tech race. Because if you can't build it fast enough, or if you feel like you are falling behind, you might just try to take it.
The espionage story. Yeah, this is straight out of a spy novel today. CNBC reported on 3 Silicon Valley engineers who were just charged with stealing trade secrets from Google.
And where were they allegedly sending this stolen data?
To Iran.
Wow. Okay, so let's just pause and look at the web we just spun for the listener here.
It's tangled.
Very. We have NVIDIA pouring $30 billion into OpenAI to stay ahead globally. We have the U.S. threatening military strikes on Iran within 10 days. And we have engineers allegedly stealing Google's AI secrets to send directly to Iran.
The tech war and the real war are literally the exact same story now. National security and economic dominance are completely fused together.
Yeah.
That is exactly why the market is so volatile today. Because a move in tech is a move in geopolitics. You really can't analyze them in separate silos anymore.
It's a lot to process. And speaking of politics and power moves, we have to look at Washington. Because while the military is intensely looking at Iran, the White House is also looking at Big Pharma.
Yes, the Trump effect on domestic policy is in full swing. Both Bloomberg and MT Newswires have some really fascinating details on a meeting between President Trump and Vas Narasimhan, the CEO of Novartis.
This was the meeting where Trump came out afterward and basically took a huge victory lap, right? He claims his tariffs completely pushed Novartis to expand manufacturing in the U.S.
That was definitely the soundbite. He told workers at a steel plant that Novartis is building new plants entirely because of his tariff policies. And technically, if you look at the facts, Novartis is investing heavily. They have new sites going up in Florida, California, and North Carolina.
But I'm guessing, as is usual with these high-stakes political negotiations, the reality on paper is a bit more complex than the campaign stump speech.
There is always more nuance. The reporting from MT Newswires really clarifies that this wasn't just about tariffs forcing their hand unilaterally. It was a classic carrot and stick situation. Novartis actually reached a deal with the White House just before Christmas.
What were the terms of the actual deal?
It was a trade-off. Novartis agreed to lower certain drug prices, and they agreed to launch new medicines in the U.S. at prices comparable to what other wealthy countries pay. In exchange for doing that, they avoid the heavy tariffs.
So it wasn't just submit to the tariffs or else. It was more like, give us better pricing for consumers, and we will let you off the hook on the import taxes.
Exactly. It's deeply transactional policy.
Yeah.
Trump uses the threat of the tariff, which is the stick, to get the pricing concession, which is the carrot. It's a very different, very direct approach to governance than we've seen in previous administrations.
It's the art of the deal, live from the Oval Office. But, it's not all victory laps and handshakes in Washington today. There is some real friction brewing in the House regarding the crypto space.
There is indeed. CNBC reports that House Democrats are actively pushing for a Treasury probe into a Trump family crypto venture.
Interesting.
Yeah, this all comes right after some apparently very chaotic testimony from Treasury Secretary Scott Bessent.
Crypto and politics, it is always an incredibly volatile mix.
Yeah.
But I have to say, amidst all this extremely heavy news, war, debt bubbles, congressional investigations, there was one headline from the Trump administration today that made me actually laugh out loud at my desk. And I think you know exactly which one I'm talking about.
I think I do. You're talking about the executive order.
The alien.
Yes. Amidst all of this chaos, Trump is ordering U.S. agencies to release documents on aliens and extraterrestrial life.
It is just bizarre, right? We are sitting here discussing the potential collapse of private credit and a 10-day countdown to war in the Middle East, and the administration says, let's see the UFO files.
It definitely feels a bit like a distraction technique, doesn't it? Like, look at the aliens, don't look at the inflation data. Or look at the flying saucers, ignore the bond yields.
It certainly works as a headline grabber, I'll give them that. But speaking of actually looking at the data and not the flying saucers, we really should check the dashboard on the global economy. Because despite the aliens and the war drums, the actual numbers are telling their own completely different story today.
Right. Let's do a quick global macro snapshot, because the data is actually quite surprising given how bad the sentiment feels.
Let's start with Japan. Why are we watching them so closely today?
Because Japan is currently the global outlier. CNBC reports their inflation just fell to 1.5%. That is the lowest it has been since March of 2022.
And why does that matter to a listener sitting in New York or London?
Because Japan has been battling for decades to get their inflation up. This drop breaks a 45-month streak of them being above their target. It suggests that global inflationary pressure, the kind that swept the world post-pandemic, might actually be cooling off in some major economies.
Which gives central banks everywhere a little room to breathe.
Exactly.
Okay, but what about right here in the U.S.? Because I'm hearing totally mixed things depending on what channel I turn on. Some say we are entering a recession. Some say it's an economic boon.
The U.S. data is remarkably resilient. GDP is expected to show a 2.5% increase. In a mature, developed economy, 2.5 is very solid growth.
And what about inflation? Specifically the Fed's favorite number.
Right, the PCE. The Personal Consumption Expenditures Index is expected to rise 2.8% year over year.
So it's sticky.
It's very sticky. It's not down to that magical 2% target yet, but it's definitely not runaway hyperinflation either.
So if the economy is growing and inflation is annoying but generally manageable, what are everyday investors actually doing with their cash? Are they hiding it under the mattress because of the Blue Owl credit news?
You would honestly think so, given the credit fears and the war talk. But no, Reuters reports that U.S. equity funds just saw their largest weekly inflow in 5 weeks.
Wait, really? Even with the 10-day Iran countdown and the credit cracks, money is still flowing in.
Yes. It's what we call climbing the wall of worry in the markets. Despite the fear, despite the massive geopolitical risk, people are still buying the dip.
Wow.
They are looking at that 2.5% GDP growth. They are looking at NVIDIA putting $30 billion into AI, and they are saying, I don't care about the noise, I want in.
That is the absolute definition of a split-screen market.
It perfectly encapsulates the Friday vibe we are seeing today. The macro data says growth, the geopolitical desk says war, and the credit desk says crash.
So let's try to wrap this all up and synthesize it for you, the listener, because we have thrown a massive amount of information at you today.
We really have. If you zoom all the way out, today is a massive tug of war. On one side, you have the fear camp. Private credit is showing real structural cracks with Blue Owl, and the geopolitical risk with Iran is driving oil and defense stocks through the roof. That is your core bear case.
And on the other side.
The greed or the optimism camp. That is completely driven by the AI narrative, the NVIDIA and OpenAI super deal, and the fundamental underlying strength of the U.S. consumer and GDP growth.
Right.
The world feels incredibly dangerous, but the financial belief in the technological future is just massive.
It feels like we are collectively walking a tightrope between a recession caused by old world problems, debt and war, and a golden age caused by new world tech.
That is exactly where we're standing. And right now, the money is heavily betting on the tech, but keeping a very nervous side eye on the war.
Before we sign off today, I have one last fun fact from the sources that I think perfectly sums up this weird inflation and commodity surge we are seeing. It's actually about the Olympics.
Oh, let's hear it.
So CNBC reported on the physical value of Olympic medals. Because gold and silver prices have surged so much recently, partly due to that exact flight to safety trade we discussed earlier, the actual melt value of Olympic gold and silver medals has hit record valuations.
That is incredible. Even the Olympics aren't immune to global inflation. So if you are an athlete, winning gold is literally a better financial investment today than it was 4 years ago, just based on the medal.
Exactly. Forget the Wheaties box sponsorship deals. Just melt the medal down.
Please don't tell them to melt the metals. But point taken, it really shows how far-reaching these commodity cycles actually are. They touch everything.
Indeed they do. And, looking at everything we discussed, it leaves me with one really big question for you to think about this weekend. If tech dominance and military power are becoming the exact same trade, what does a truly peaceful market even look like anymore?
That is a phenomenal question to end on.
It's been a heavy day, a very complicated day, but hopefully we made the tape a little clearer for you.
Just keep an eye on those headlines this weekend, especially that 10-day clock regarding Iran. That is the one variable that changes everything else on the board.
We certainly will. Thank you for listening to this deep dive, and remember that we will see you all Monday morning with new headlines from major financial magazines.